Have you noticed something strange lately? A lot of people are looking at houses and asking the same question. Who in the world is actually buying these homes? Seriously, scroll through real estate listings for just a few minutes. A modest-looking house costs $400,000. Another one costs $500,000. A slightly newer one costs $600,000. And suddenly, millions of Americans are staring at their screens, wondering if home ownership has become some kind of luxury product. Because not very long ago, a $500,000 home sounded expensive. Today, in many parts of America, it's becoming normal. And that's exactly why this conversation matters. Because most people don't realize how brutal the math actually is. They see the home price, but they never calculate what it really takes to afford it. And trust me, once you understand the numbers behind a $500,000 house in 2026, you'll understand why so many families feel financially stretched. You'll understand why first-time buyers are frustrated. And you'll understand why two households with the same income can end up in completely different financial situations. Now, before we begin, let's make something clear. This isn't about whether buying a home is good or bad. For many people, owning a home can be a great long-term decision. The problem is that most people focus on the sticker price and completely ignore the full financial picture. Because a house payment isn't just a house payment. It's a package of expenses, a very expensive package. And that's where the brutal math begins. Let's start with the number everyone sees: $500,000. At first glance, it sounds straightforward. $500,000. But almost nobody pays for a house entirely in cash. Most buyers use a mortgage, and that's where things start getting interesting. Because the monthly payment depends on several factors: the down payment, the interest rate, property taxes, homeowner's insurance, maintenance, and sometimes HOA fees. Yet many people only think about one thing: can I afford the mortgage payment? That's a dangerous mistake, because the mortgage is often just the beginning. Now imagine someone buys a $500,000 house. Let's say they put down 20%. That's $100,000 up front. Already, most Americans have a problem, because saving $100,000 is extremely difficult. For many families, that amount alone takes years to accumulate. Some never reach it at all. But let's assume they do. That leaves a $400,000 mortgage. Now comes the monthly payment. Depending on interest rates, the principal and interest payment alone can be several $1,000s every month. And that's before taxes, before insurance, before maintenance, before repairs, before unexpected emergencies. Because houses have a funny way of demanding money at the worst possible times. The roof doesn't ask if you're ready. The water heater doesn't care about your budget. The air conditioner doesn't check your savings account before breaking. Problems happen, and homeowners pay. Now here's where many people get into trouble. They calculate what they can technically afford, not what they can comfortably afford. There's a huge difference. A bank might approve someone for a large mortgage, but approval and affordability are not the same thing. A bank is asking, can this person probably make the payments? You should be asking, can I make these payments while still building a good life? Completely different question. Because what's the point of owning a beautiful house if every month feels financially suffocating? What's the point of having a dream home if you're constantly stressed about money. That's where the brutal math starts revealing itself. Let's imagine two households. Both earn good incomes. Both qualify for similar mortgages. Both purchase expensive homes. But one family spends almost every extra dollar on housing. The other keeps housing costs under control. 10 years later, the difference can be enormous. One family built investments, the other built stress. One family created flexibility, the other created obligations. And it all started with a housing decision. Now let's talk about income, because this is where the conversation becomes uncomfortable. Many people assume that if someone owns a $500 house, they must be wealthy. Not necessarily. Some are. Many aren't. Some households simply dedicate a massive percentage of their income to housing. That's why appearances can be misleading. A nice house doesn't automatically mean financial freedom, just like an expensive car doesn't automatically mean wealth. Sometimes it means the opposite. Sometimes it means a family is carrying enormous financial pressure behind the scenes. And that's something social media rarely shows. Social media shows kitchens, backyards, pools, renovations, beautiful furniture. But it doesn't show the monthly mortgage payment. It doesn't show the anxiety. It doesn't show the sacrifices. It doesn't show the delayed retirement contributions. It doesn't show the lack of emergency savings. It only shows the highlights. And that's why so many people compare themselves unfairly. They compare their reality to someone else's highlight reel. Now here's something even more important. The real challenge isn't buying the house. The real challenge is owning it for decades. Anybody can get excited during the purchase. The difficult part comes later, month after month, year after year. When life happens, when jobs change, when expenses rise, when unexpected emergencies appear. That's when affordability gets tested. Not on closing day, but 5 years later, 10 years later, 15 years later. And that's why financial experts often focus on margins. Margins create breathing room. Margins create flexibility. Margins create peace of mind. Without margins, every financial setback feels larger. Now think about this. What would happen if someone lost their job? What if medical expenses appeared? What if the economy slowed down? What if investment opportunities emerged? Financial flexibility matters, and every dollar committed to housing is a dollar that can't be used elsewhere. This is called opportunity cost. One of the most important financial concepts in the world. When you spend money in one place, you lose the ability to use it somewhere else. That's true for everyone, even wealthy people. And that's why some financially successful individuals intentionally buy less house than they can technically afford. Not because they have to, because they want options. Options matter a lot. Options allow investment. Options allow career changes. Options allow entrepreneurship. Options allow freedom. And freedom is often more valuable than square footage. Now let's talk about something most people never consider. Lifestyle inflation. Because this is where many high-income earners get trapped. They make more money, so they buy a bigger house. Then they need nicer furniture. Then they need more decorations. Then they need more maintenance. Then they need more everything. And suddenly their higher income disappears. Not because they failed, because their lifestyle expanded alongside their earnings. That's one reason some people earning six figures still feel broke. They increased expenses every time income increased. And housing is usually the biggest expense of all. Now here's the reality nobody likes hearing. A $500,000 house doesn't make someone successful. A $500,000 house doesn't make someone wealthy. A $500,000 house doesn't guarantee happiness. What matters is what happens around the house. The savings, the investments, the flexibility, the financial security, the peace of mind. Those things matter far more over the long run. And that's why the math is so brutal. Because the true cost of a house isn't just the purchase price. It's every financial choice connected to that decision for years afterward. That's what most people miss. They see the house. They don't see the decades of consequences attached to it. And once you understand that, you start asking a different question. Not, can I buy a $500,000 house, but can I buy a $500,000 house and still build the future I want? Because those are two completely different questions. And the answer can completely change your financial life.